Welcome back to the Dividend Diplomats YouTube channel. You got your boys Bert and Lanny, the Dividend Diplomats guys, and we're here to talk about two dividend stocks that our fellow commenters have been wanting us to evaluate over the last week. So we're putting it out there, running them through a screener, giving our quick dividend stock take to see if these are two, maybe one or none, zero stocks to buy out of this list.
Before we do that, everybody, look down, hit that subscribe button. Give this video a thumbs up, help spread the love of dividend growth investing. You know, I think you hit an interesting point here, Lanny. We always ask the commenters to give us stock recommendations. We keep doing that. So you know what? We wanted to throw it out there, everyone. You asked us to run some stocks through it. We're going to do that. And you know what? Not every stock in our channel has to be a stock to buy at the moment we are evaluating them. That's why you look at the metrics. You don't buy everything. You look at them, you cipher them out. They may meet your metrics, they may not. So we're going to be interested to see if these two companies are going to leave this on our radar or not. I think it's going to be a fascinating conclusion.
Oh, it's going to be a fascinating conclusion here, guys, because we're in the oil industry. Yes, the oil industry that is setting profit records, revenue records, juicing up dividends, except for ExxonMobil. Sorry about that. You know, obviously energy is performing very well right now. So these are two stocks in that arena.
Yeah. So how are we going to look at these companies? What metrics do we use to evaluate undervalued dividend growth stocks potentially? The Dividend Diplomats Dividend Stock Screener. Metric 1, PE ratio less than the S&P 500. And you know what? This year, the S&P 500 is hanging in the high teens. It's typically what, between 18 and 19 and 20 right now, Lanny. That's where you're going to find it sitting in 2022. Metric number 2, that dividend payout ratio. This one helps measure the safety of your dividend, because in the long run, you can't pay out a dividend that exceeds your earnings. That's just not sustainable. So we always use 60% as a kind of eyeball there to make sure that there's plenty of room for a company to keep growing that dividend. Although I should say, perfect payout ratio ranges between 40 to 60%. Let's see if either of these two companies fall within that range. That third metric, the dividend growth history, we look at the 5-year average dividend growth rate and how long a company has increased the dividend. And Lanny, what's our unofficial bonus metric of the screen?
Check out that dividend yield, because you want to know how much passive income right now will this stock pay you. In case you wanted to turn off dividend reinvestment or DRIP, use that dividend income to pay for your normal everyday cost of living. But guys, you know, here at the Dividend Diplomat channel, we turn on that DRIP, baby. But regardless, we are looking at two stocks in the energy field. Yes, calling you out. You want us to look at Halliburton and Energy Transfers. So we're going to take one company at a time today and just run through the metrics just to see what they're really looking like. And we're going to start with the Halliburton company. Ticker symbol is HAL. And guys, this is one of the biggest companies in fracking operations here in the United States. They're also involved in the generation of oil, so no shock there. Headquartered here in Houston, Texas. Obviously, the kind of like the granddaddy, the crib of all the oil. So if you need oil, head down to the south of, you know, big Houston, Texas, guys.
H-Town.
H-Town. Guys, this stock is up 60% this year. They're up 56% over the last 52 weeks. What the heck's going on with the Halliburton company, Bert?
That's fair. But I also think if the stock's up 60%, you know what? This will make running them through our stock screener even fascinating, because a stock can be up and still be undervalued, but we're going to have to see the metrics to see how they play out. Their current price, $38.48 forward EPS for good old Halliburton, $2.94. That's a PE ratio of 13.09. Let's check out the other metrics here. Lanny, you want to tell us about the dividend payout ratio for Shallow Hal?
The safety in the dividend for this fracking company, this oil pumper over here. They pay a 12 cents.
Pumper. That's
They pay 12 cents per share per quarter, 48 cents a year, dividing that over $2.94. They have a payout ratio of only 16%. Very safe, guys. But you know what's not safe is keeping the dividend.
Yeah, I was going to say, it's easy for you to have a low payout ratio when you cut your dividend in 2020 and you haven't increased it back. Back at the beginning of the pandemic, they used to pay 18-cent per quarter dividend. They cut it down to 4.5 cents a quarter. So that's a huge decrease, obviously.
It's true.
It's probably prudent, though, that management hasn't run back to increase it to that previous level, especially with the volatility in oil. So from a dividend investor perspective, it sucks because they haven't brought it back up. But from a management, cash flow, future long-term investment standpoint, it's probably not the worst idea.
Yeah, I mean, obviously, I think there were many oil companies, not, the big names, not the big dogs like Exxon and Chevron that, had cut and reduced their dividend, Occidental Petroleum. But, Halliburton obviously was one of the same, cutting and reducing their dividend. Even Shell, one of the bigs, did reduce their dividend as well. And they actually did increase their dividend recently from that 4.5 cents to the 12 cents, which is great. But yet they are still down from that 18 cents per share per quarter pre-pandemic levels. So you really don't, as a new investor or an investor looking for an opportunity, it's always hard to bite into a new apple that, just within the last 24 months cut their dividend.
Yeah, it's true. It's damn true, Lanny. But
how's that juicy big dividend yield looking, right?
Oh, that's where I was going with it. Surely they must be paying a massive dividend. It's bad when Qualcomm is doubling up your dividend. When you're getting doubled up by a tech sector and you're an oil company, that's not great. Halliburton's dividend yield is a blistering 1.25%.
So guys, Halliburton, 13 PE, 16% payout ratio. Dividend growth, yes, they just increased their dividend. Yes, in the last 5 years, it's actually up in 5 years, maybe about 5.5% the growth rate. But they did cut it once 2 years ago. Obviously, I'm sure they've learned their lesson, but I can never say that. Hard to say that. So metrics aren't bad, but I think that in the energy, you don't want to only earn a 1.25% by owning a more volatile based on, a lot of macro conditions that can impact your dividend investment.
And that's why a few weeks ago, I ultimately decided to cut bait with Schlumberger, who had a very similar lower yield from there. So obviously this isn't something I'm looking at right now because I cut bait from a competitor in the sector, but it's worth looking at to keep an eye on this and just make sure that you're aware of what's going on within the sector. But Lanny, that was one company here, right? We talked about how we're going to evaluate two companies.
All right, let's dive in, guys. We're going to Energy Transfer. Ticker symbol is great. It's ET.
ET phone home here. Could resist that one.
And again, they're based also in Texas. This time, I think they're in the Dallas area. They're an LP. So just remember that, guys. They're a limited partnership entity. Kinder Morgan kind of had that, but then they ultimately collapsed everything into one company. But they're a massive player in the natural gas and propane pipeline transportation. So, again, in the energy industry.
I completely forgot about that with Kinder Morgan. That was a long time ago too, when they just folded everything into one. That's a blast from the past right there. So obviously, let's jump into the metrics and see how they're going to compare. And let's just see what the numbers tell us. Their price, $12.30, earnings per share, $1.56, PE ratio, 7.88.
Okay. So, low stock price, low PE ratio, more in line with kind of where the industry is at. Now, they'll have a payout ratio. Remember, we like 40 to 60%. So remember, Halliburton pays 12 cents per quarter. Well, they pay at 23 cents per share per quarter. So it's pretty interesting there. So you already know what's about to happen. But they pay 92 cents in a dividend per year, obviously divided over 4 quarters. The payout ratio is under 60% at 58.97%. And Bert, I can't wait to hear you talk about dividend growth.
Dividend growth, because it sounds very similar to Halliburton. They also cut their dividend during the pandemic, everybody. We say it with excitement here. Their dividend before was 30.5 cents per share. Now it's 15.3. So they also had a cut. So they've increased it once. Since then, much like Halliburton, their streak's at 1. You got to start somewhere. But again, you can't say that there's a long-term history of dividend growth because when the times got tough, they cut it. That's where they deviate from, your Exxons, your Chevrons, and all the other major oils that didn't necessarily have that same level of cutting.
No, exactly. So, again, they were at 30.5 cents. Now they're at 23 cents, still below their pre-pandemic. And again, they cut it in the last 24 months. Hard bite, a hard thing to chew on. But what Halliburton, did in their dividend yield to what Energy Transfers has is a completely different story. This is where you can kind of evaluate it. Like, are you earning, are they paying you for the risk that you're taking in the industry? If you own ET, the answer is yes, because that dividend yield is 7.48%. This stock is up 41%. So up that much with the dividend yield that high, with the payout ratio below 60%, I mean, that's you're getting paid for the risk.
And you're absolutely right. And it's great that you highlighted that. It's a great contrast seeing the two stocks against each other for that reason. You can deal with certain things if you're going to get paid for it. And a 7.4% yield at least keeps you at the table for energy transfers versus Halliburton, where you wouldn't even necessarily consider it.
And actually, guys, I'm gonna have to go back. The dividend is 26.5 cents per share because they did just increase it. So $1.06 per share per year, which is a 68% payout ratio. Hot take with an 8.62% dividend yield. So higher on the payout ratio, but now even higher on the dividend yield standpoint.
Look how fast the income just grew in our analysis here for ET. But yes. Okay, I mean, I don't think it ultimately changes what we said when we thought it was the previous the dividend earlier on. I exact same conclusions apply. You're just getting paid even more to take on that risk. That's awesome.
You're getting paid, call it almost 7 times what Halliburton is paying you. Again, LP, they're going to be paying out to shareholders. It's all going to flow back to the partners, which would be you as the owner. So, again, in summary, you've got an APE, a 68% dividend payout ratio, kind of a neutral dividend growth because they were growing it, cut it, back to growing it. And then you've got a yield of 8.62% on this high yielding stock.
The yield is higher than the PE ratio. Love it when that happens. So, Lanny, what are your thoughts on these two companies? I know we kind of talked about Halliburton already. Anything changing after looking at them side by side one more time before we end the video?
Again, Halliburton, I just don't think it warrants owning it because you're not getting paid for the risk of owning oil. What's your take there?
No, I agree.
But again, I'm not here to, obviously do your own investment research, but that's something that I just, wouldn't do.
Also, remember one thing to consider with this, Laney and I already have pretty heavy allocations in oil too. So the bar for us to add an oil company is going to be a little bit higher because we already have a nice allocation in there. That you may reach a different conclusion if you're a beginning investor and you're trying to find your first oil company in there where you're willing to take a little bit more of a risk in one of these companies as you build out your oil allocation. We're already there, so it's going to take a lot for us to want to add more. And similarly with ET, got a lot of oil exposure. Bert, I'll let you go, but I've got Shell, I've got Total, I've got Kinder Morgan. I'm sure I got some others. My wife's got Exxon in her portfolio, so there's oil everywhere. Yeah, we got them everywhere. So again, it's not like we're like screaming, "Hey, we need one." We're covered here. But now, but from an ET standpoint, if you're looking for an income, if you want to, it seems like the dividend is safe right now. Obviously, that could really turn if oil turns again. If you're a current shareholder, hopefully your exposure is small, and you're spreading your risk because, anything with a higher yield like this, I know there's going to be the Altria investors out there and some other names, but, you got to ask yourself, is it sustainable? Am I protecting my portfolio in case a downturn happens, a recession happens, in case oil gets, again, just got to really think about that. Yep, it's a commodity. And I think that's one of the lessons we've had to take away. So please, it's a great call out. Please make sure you're always considering that. And also let us know in that comment section below what your thoughts are about Halliburton, what your thoughts are about ET. Are you running to buy either? Are you passing on both of them like we are right now? let us know your thoughts. And obviously, too, any other stocks you want us to look at, put it down there too. We're all about finding and analyzing these stocks.
And we're not experts in this industry, so please leave your feedback on what you guys know about, obviously the natural gas, propane industry, and just other tidbits so we all can learn. So again, I appreciate the comment to evaluate these stocks. I really haven't lifted the hood on them. Again, great companies. I'm sure, they've been around for a very long time. But yeah, so leave your feedback, leave other stock considerations, and we'll jump to them and add them to our list. Or what else you got for us?
It's really it, everybody. Let's keep finding stocks, keep growing our income. That's what it's all about.
Guys, that was Bert the Hurt Inlandy from the Dividend Diplomat, over and out.